Dear professional students, you are welcome to another course, which is fixed income valuation. And under this course, we will looking at time value of money. What is time value of money? When we are talking of time value of money, this simply means the money received in present is of higher worth than the one received in the future, as money received now can be invested and it can generate cash flow to enterprise in future in the way of interest or form of investment appreciation in the future and from reinvestment. So the time value of money is also referred to as present discount value. Money deposited in savings bank account earn a certain interest rate to compensate for keeping the money away from them at the current point of time. As a result of this, if a bank holder deposit 100 naira in the account, expectation will be to receive more than 100 naira after 1 year. So what this time value of money is trying to portray is that the money you receive today is definitely going to be higher than the one you will receive tomorrow. And it is not automatic. Please, let's understand it. It is not automatic that money you receive today will definitely be higher than the one to receive tomorrow. The rationale behind that is that the money gotten now will not be put under the pillow or in your local safe. Yoruba call it kolo. You are not dropping money in the kolo and expect it to be valuable or have more value than the one you receive tomorrow. The money you receive today is supposed to be put into an investment platform where it will yield more. And it is time that the interest rate is counting. That is why they say that the money you have today and you put into investment platform will start counting money and be yielding more money than the one you want to receive tomorrow. What will be generated between now and tomorrow, the one you are receiving tomorrow will not generate it. That is why we said the money you receive today is far better than the one you receive in the future. And that is what all the concept of time value of money actually centers around. And to further explain time value of money, this is a concept that recognizes that relevant worth of future cash flow arising as a result of financial decisions by considering the opportunity cost of the fund. Since money tends to lose value over time because of inflation, which reduces the buying power of the money. However, the cost of receiving money in the future rather than now shall be greater than just loss its value on account of inflation. The opportunity cost of having not the money right now also include the loss of additional income, which will have been earned by simply having possession of the cash earlier. What we want you to understand here is that inflation is not time value of money. Fine, with time, inflation lets money loses value. But if you don't have your money in your position now, you will lose more value. Inflation is a kind of external factor that faces a cash you have. It reduces the buying power or the purchasing power of money. But if you have your money with you on the right time, you can plan in order to make more money and salvage the effect of inflation on your cash or on your fund. So that is what we are trying to say. And moreover, receiving money in the future rather than now may involve some risk and uncertainty regarding its recovery. So this reason make the future cash flow to be worth less than the present cash flow. It is money you have. People say a bird at hand or a bird in the hand worth millions in the bush. Is what you have in your hand that you are sure that you have. The one you are expecting to borrow is not certain until you have it. That uncertainty of taking position of the future cash is another problem that make the future cash to be also worthless, but not totally worthless, but of less value than the present cash flow. There are about 6 term the time value of money concept that I want to look at here. And the first one is what? The single or future value of a single amount. We want to know the future value of a single amount. And the first one in that, or in the time value of money concept that we discuss, is to calculate the future value of a single amount, just single amount. As you can see on your screen, suppose one invests 1,000 for 3 years in a savings account which pays 10% interest rate. If one allow the interest income to be reinvested, the investment will grow. What we are saying that for the first year, you put your principal here, the principal will generate 100 naira. It will become what? 110. That's for year. For the second year, it will be 10%. 10% multiplied by 110. That one will generate more money. And in the third year as well, the same thing will happen. So you continue having more money on your watch, on your purse. That is what we mean by time value of money. And for the third year, let's just try to, for the first year, your money becomes, at the end of the first year, your money becomes 1,100. And you invested in interest. It means that your money will become what? 1,100 times 10% again. And that one. So for the second year, your money becomes 1,210 naira. And for the third year, or end of the third year, it is also 1,210 multiplied by 10%. So that one will make your money to become 1,331. Now, if it is like this, if you invest your money for 3 years, it is like this. Let's assume you are not in possession of this cash. How can you make 331 naira on your money? Let's assume someone has promised that in 3 years' time I'll pay that 1,000 naira. You still have 1,000. You have lost 331 naira you're supposed to have made if you had received it 3 years ago and invested it at the rate of 10 naira. Are we together? So, but this is just in a, how do I put it? In a say simple interest way or whatever. We can use a model to calculate it. The model is 1 plus r raised to power n. That is future value is equal to present value into 1 plus 1 and 1 plus r raised to power 10. So present value is 1,000 invested into 1 plus 1 raised to power 3 is equal to, when you put it will give you 131. Okay, that is if you want to use a model for a single amount, irrespective of the year you want to calculate. Just use this model, you get your answer. And if you choose to be calculating it on a yearly basis, you also get it. But for the sake of knowledge and exam, apply the model. That is on that. Another concept we want to look under this time value of money is what? Is time value of money under doubling period. So the first important aspect of the time value of money concept is doubling period. So investors are generally keen to know when their investment can double up at a given interest rate. Though a little crude, An established rule is what? Is the rule of 72, which states that doubling period can be obtained by dividing 72 by the interest. For example, if the interest rate is 8%, doubling the period is 9 years, which means 72 divided by 8. So we can double the investment, it will be up to what? 9 years. And if you look at this chart, for 1,000 to become 2,000, it will take that far. The third way is to calculate the present value of a single amount. We calculated the future value of a single amount. We want to now calculate the present value of a single amount. And the present value of a single amount is given as what? The future value all over what? All over 1 plus r raised to power n. In our example, the future value of 1,000 after 3 years is given to be 1331. So if you want to calculate the present value will just be what? Present value will be equal to, according to the model, which is future value over 1 plus r raised to power n, it will be 1331 all over 1.1, 10% is the interest rate, all over 3. So present value will be equal to 1,000. And you can see this example as well. For instance, a client expected to receive 1,000 after 3 years at 8% return on investment. So at present, it will be calculated by what? By the same model. Present value will be equal to future value all over 1 plus r raised to power n. The future, what client expected to receive is 1,000 naira. So present value will be equal to 1,000 naira all over 1 plus 0.8, it is 8% here, raised to power 3. So the answer is 794 naira. So the present value, what the client is supposed to have now for him to be able to get 1,000 naira in 3 years' time is 794 naira. That's on the present value of a single account. The next one I want to look at is what we call future value of an annuity. Future value of an annuity. And the fourth important concept in the annual money, in the term value of money, is what we call, or how to calculate the future value of an annuity. An annuity, by meaning, is a stream of constant cash flow that we receive or pay, which occur at a regular time interval. That is what we know as annuity. And the premium payment for a life insurance is another example of annuity. And when cash flow occur at the end of each period, we call that one an ordinary annuity or deferred annuity. And when this cash flow is at the beginning of the period, we call it annuity due. Now, example of annuity due is the rent. The rent is usually at the beginning. That is an example of annuity due. And the formula of annuity due is simply 1 plus r times the formula for corresponding ordinary annuity. So our focus will be more on deferred annuity, which is known as ordinary annuity. Now, let's take an example whereby one deposits 1,000 naira. You deposit what? 1,000 naira. Annually, it will account for 5 years, or into a bank for 5 years. So the deposit is earning the compound interest at 10%. This is present value that you deposited, and the rate is what? Is 5%. compounding annually. Sorry, the rate is what? Is 10%. Compounding annually. So the value of series of deposits after 5 years will look like this. Let me show you the table. The first year you deposited is what? 1,000, second year 1,000, third year 1,000, fifth year 1,000, and fifth year 1,000. Now, what is the value of all this? You will discover that as you are depositing it, the first one you deposited is 1,000 RB. This 1,000 in the second year, you deposited this one. This is multiplied by 1 plus R. It will go up. In the third year, it will be like this. In the fourth year, it will be 1,000 plus what it appreciates to. And the last year, it is 1,000 into 1 plus 1.1 raised to power 4. That's how you continue doing it. Are we together? But there's a model, which is this. That is, future value of annuity is equal to present value of annuity, which is A, into 1 plus R raised to power n minus 1, everything divided by R. Our A is the constant periodic flow, which is the present value that I told you. And our R is the return on capital by the period. So this term, 1 plus R raised to power n minus 1 divided by R, is the future value interest factor. So if you apply this model, you still get the same answer. How is it working? Let's try to look at the vocabulary of this model here. What we are saying is that the model is 1,000 into, anyway, before you deal with 1,000, first of all deal with the alternating factor, 1.1 raised to power 5, 5 years AB, minus 1. Whatever you get, all over R is 10%. So use your calculator properly. The answer will be 6,105. Let me just show you how you press the calculator. First of all, you will press 1.1. Press 1.1 raised to power 5. That one will give you, your 1.1 to the power 5 will give you 1.6105. 1. Understand? Minus this one. Minus 1 will become 0.61051. Understand? Now, divided by 0.1, which is R, remember this R. So it will give us divided by R. It will give you what? 6.1051. So you now multiply by 1,000. So the final answer will now be 6,105.1. So approximately 6,105. That is how it is done for the future value of annuity. Now,